Welcome to NTD Business. I'm Don Ma. Treasury Secretary Janet Yellen kicked off a four-day visit to Beijing on Friday. Yellen emphasized that the United States seeks healthy competition with China and not to separate the U.S. economy from China's.
I've made clear that the United States does not seek a wholesale separation of our economies. We seek to diversify and not to decouple. A decoupling of the world's two largest economies would be destabilizing for the global economy.
Yellen's trip is focused on improving the U.S.-China relationship. She says the U.S. is not looking for a winner-take-all scenario. For a more in-depth look, head on over to NTD's China in Focus program. And Twitter has threatened to sue Meta over its new Threads app. This is according to a letter sent to Mark Zuckerberg by Twitter's lawyer Alex Spiro. Meta launched Threads on Wednesday and has logged more than 30 million signups. In the letter, he accused Meta of hiring former Twitter employees who, quote, had and continue to have access to Twitter's trade secrets and other highly confidential information. News website Semaphore first reported this. The letter says Twitter intends to strictly enforce its intellectual property rights and demands that Meta take immediate steps to stop using any Twitter trade secrets or other highly confidential information. Spiro wrote in the letter. Though Meta spokesperson Andy Stone says that no one on the Threads engineering team is a former Twitter employee. Meanwhile, Twitter owner Elon Musk said competition is fine, cheating is not, in response to a tweet citing the news. The U.S. economy added 209,000 jobs last month. Now, this is the fewest number of jobs added in 2.5 years. But the pace of job growth remains strong by historical standards. We also saw strong wage growth in this report, 0.4% increase month over month. Labor force participation rate held steady at 62.6%. The Labor Department's employment report on Friday also showed 110,000 fewer jobs created in April and May, indicating that higher borrowing costs were starting to dampen businesses' appetite to continue hiring. There was also a jump in the number of people working part-time for economic reasons last month, in part because their hours had been reduced due to work slack or business conditions. Number of employed people part-time for economic reasons increased by 452,000 to 4.2 million. Now, contributing the most to the number of jobs added was government. Government jobs increased by 60,000. Healthcare payrolls rose by 41,000 jobs, and construction employment jumped by 23,000. For further analysis, here with me is Julia Pollock, chief economist at ZipRecruiter. So after 13 consecutive beats of expectations, we now get a softer print for the jobs numbers today, but still about 200,000. So pretty solid. What are we seeing with this report?
This is still a solid report. Unemployment is still very low at 3.6%, and 209,000 jobs added is nothing to sneeze at, but there are clear signs that the labor market is cooling. Let me walk you through just a few of those. So one, this is the lowest print since December of 2020. Two, the job finding rate for unemployed workers has gone down below its pre-pandemic sort of average. Three, temporary help services employment keeps falling. That is usually a leading economic indicator and something to watch. We also saw a big increase in the number of workers working part-time for economic reasons because their hours were cut or because they couldn't find full-time work. That's another sign of sort of softening demand for labor. And lastly, the unemployment rate for Black workers rose to 6%. Now, that's a very noisy series. It could just be statistical noise. But we do know that when labor market conditions soften, it is typically underrepresented workers who get hit first.
Do you think the Federal Reserve's interest rate hikes are finally having an impact on the labor market?
That is very much the takeaway that I would take from this report. Yes, the labor market is finally starting to feel the effects of higher interest rates.
And wages also went up, but that's a good thing, right?
Well, it's probably not a good thing for the Fed. They don't want to see the sort of annual growth in average hourly earnings go up. That said, that number, 4.4%, is quite different from what you see in the annual growth in weekly earnings. Because the work week has actually become a lot shorter over the past year, weekly earnings have only grown 3.7% over the past year. And that number may be roughly compatible with 2% inflation. The thinking there is that workers need to get about a 2% boost each year to keep pace with inflation, and then 1 to 1.6% on top of that for productivity gains.
So among other reasons, you said the number of people working part-time increasing contributes to the weakness in the labor market. Can you elaborate on why that is?
Sure. So specifically, workers working part-time for economic reasons. That's workers who would be working full-time if they could, but whose hours have been cut recently, either because there just isn't enough activity or because there aren't full-time jobs available. The decline in hours over the past year is also because many of the jobs added have been part-time, some for voluntary reasons. There are workers who are picking up part-time jobs because they want to. But the fact that we're now seeing an increase in those who are taking on part-time work because they have to is a bit more concerning. And it suggests that there are workers who are increasingly underemployed.
Do you expect this report to be an outlier, or is this going to be a continuous trend going forward?
So I think we are now back to a sort of sustainable labor market that's no longer overheating, that's adding jobs, that's sort of a solid, steady pace. I think that we could see stronger reports than this going forward for a number of reasons. One is that employment overall is still well below its pre-pandemic trend. There would be a lot more people employed in this economy if the pandemic had never taken place. And so there's still a lot of catch-up hiring that might take place in the coming months, especially in the government and in childcare services and in industries that were hardest hit. Another reason is we've just had an almost 15% year-to-date return in the stock market and a rebound in consumer confidence, which could bode well for activity going forward.
Right, the so-called wealth effect,
right.
So to speak. Another point, unemployment rate is 3.6%, but as you mentioned before, labor force participation rate is still below pre-pandemic levels. So I'm wondering, even though the rate is historically low, perhaps you're not getting the full economic benefits of low unemployment because of the historically low labor force participation rate.
So that low participation rate is entirely driven by the exodus of workers over the age of 65. Even workers aged 55 to 65 are back in full force. The result has been actually that we've seen increased employment for prime-aged workers. So the prime-age employment to population ratio is now 80.9%. That's the highest since 2001. And among women, it's 75.3%, which is the highest ever. And that's an exciting trend, partly driven by sort of pre-pandemic trends in women's participation, in women's education, and perhaps also by the shift to remote work.
Are we still seeing worker hoarding because of labor shortages?
There is some evidence of that. Layoffs and discharges across the economy, we discovered in the most recent JOLTS report, are about 20% lower, 21% lower than they were before the pandemic. In some industries, like other services, that's nail salons and laundromats and those kinds of businesses, layoffs are about 50% lower than normal. In accommodation and food and restaurants and hotels, say about 34% lower than usual. That means that there are many employers who can't afford to lay off even low-performing workers or to fire low performers because they just don't think that they could replace them easily.
And what do you think the Fed is feeling seeing this report? We had solid numbers, 209,000, but wages still going up. What do you think?
So I think the Fed will want to see what happens with the inflation data next week. I think this report with various mixed signals won't be decisive, but they'll want to sort of wait for the totality of data, as they like to say, before they make a decision.
All right, and another thing, we had the ADP job numbers yesterday, and it was very much a contrast to the numbers today. Yesterday, it was more than double expectations. Is there anything to be said here?
Yes, well, which is just that I think we always need to look at as many data sources as possible to figure out what's happening in this enormous and extremely complex economy. And there are very mixed signals, and that's because there are divergent trends across different parts of the economy. The goods-related industries like retail, transportation, and warehousing are contracting as Americans shift their spending back from goods towards services. And tech remains a weak spot. Workers clearly are less confident in tech than they were before the pandemic. There's less job switching happening, and there are more layoffs still than was normal before the pandemic.
And as well, the biggest contributor to today's numbers are government jobs. Why do you think that is?
That government employment still hasn't fully recovered. Government has been lagging behind the private sector when it comes to recovering the jobs lost in the pandemic, and it's good news that finally government hiring is picking up. One reason is that government agencies couldn't compete with the private sector on wages and benefits and flexibility. We are seeing sort of delayed catch-up trends taking place in the government now. An increase in the share of government postings that are remote, for example, higher wages in government jobs that are making them more competitive and more successful.
And just one final thing, is the labor market still tight?
Yes, this is still an incredibly tight labor market by historical standards, but there are also signs that workers have lost some leverage since the sort of peak tight period of the labor market, which is the end of 2021 to sort of the first quarter, or about mid-2022.
All right, thank you so much today, Julia. Always great speaking with you.
Good speaking to you too.